When most people start with $100, their minds leap into get-rich-quick mode. They picture doubling their account in a week, hitting 1,000 in a month, quitting their job soon after. That fantasy is the precise reason most people fail. Turning 100 into 1,000,000 is not about speed. It is about thinking in decades, not days. It is the compounding mindset, the belief that slow, consistent, strategic growth beats fast, reckless gains every single time. This mindset is built on patience, discipline, and long-term vision. It will not flood you with adrenaline. It won't give you the drama of huge bets or wild swings. But it is the same pattern of thinking that built fortunes in every industry, from Warren Buffett's long-horizon investing to methodical rule-based trading. The compounding mindset trains you to protect your capital, grow it steadily, and avoid sabotaging your progress. The average trader looks at $100 and shrugs. The future millionaire sees a seed. You don't eat the seed. You plant it, water it, protect it. If you keep digging it up to check whether it's growing fast enough, you destroy it. In markets, that means resisting overtrading, resisting oversized risk, resisting random setups taken out of boredom. A small account demands respect, because the way you treat the small will become the way you treat the large. Consider the math that most people ignore. If you grow 5% per week, it doesn't look exciting on day one. $5 on 100 is laughable to an impatient mind. But 5% compounded for long enough turns a small sum into something substantial. 100 can become thousands, then tens of thousands, then beyond, if the behavior stays consistent as the numbers scale. Growth multiplied by time creates outcomes that feel impossible at first glance. Most traders never think this way. They risk 50% on a single trade because a quick win would feel good now. If the first 2 trades lose, the account is nearly gone, and their emotions are wrecked. The compounding mindset separates winners from losers by refusing to measure success by one trade or 1 week. Success is measured by a long series of disciplined actions across months and years. This is how great traders and builders operate. Think of Richard Dennis, who started with a small stake and compounded it into hundreds of millions by applying consistent, repeatable rules. It wasn't magic. It wasn't gambling. It was system over impulse, process over excitement. And that's the mindset you need, even if you're starting with less than 1% of what he had. Losses look different through this lens. Most people panic at a loss because they interpret it as a personal failure or a threat to their identity. A compounding thinker sees a loss as a calculated cost of doing business. A 2% drawdown today can be recovered within the plan tomorrow, without reaching for revenge trades or desperate risk. Detachment like this is critical, because once a single bad trade provokes you into chasing, you've already lost the mental game. Trading isn't just charts, it's your mental state at decision time. If you're chasing quick money, you live in anxiety. Every tick feels life or death. You can't think clearly. The compounding mindset removes the pressure to get rich right now, and replaces it with the intention to make the right move consistently. Less stress, better decisions, better outcomes. Comparing yourself to others fuels impatience. You see a screenshot of someone flipping 500 into 5,000 in a week and you feel behind. What you don't see are the risks they took, or how often those accounts blow up right after the screenshot is posted. The compounding mindset ignores the noise. It's about your journey, your rules, your pace, principles you can keep regardless of what the market does. Imagine this. You have $100, and your goal is 3 to 5% per week. Your strategy gives you 2 or 3 high-quality setups. You risk 2% per trade. On $100, that's $2 risk to make 4. It seems small. Months later, the account is 500, then 5,000, then more. The process stays the same, only the zeros change. That is how small accounts become large without blowing up along the way. Starting small has a hidden benefit. It forces you to learn risk control before large money is at stake. Traders who suddenly get access to big capital often lose it quickly because they never learn to respect the small. If you learn to respect $100, you're training yourself to respect 100,000. Same game. Bigger scoreboard. The compounding mindset is not passive. It doesn't mean sitting back and hoping. It means continuously refining your edge, learning from mistakes, and adjusting to conditions, always within controlled risk. You're not swinging for home runs. You're getting on base, again and again, and letting time do the heavy lifting. 6 months of chasing quick wins can leave you back at zero. The same 6 months of consistent growth builds a track record that attracts bigger capital when you're ready. One path delivers quick dopamine hits and long-term frustration. The other builds discipline, confidence, and the potential for real wealth. This mindset is not just about money, it's about identity. You stop being a gambler and start being a professional. Professionals think in systems, probabilities, and long-term goals. Gamblers think in luck, hunches, and one big hit. Markets reward professionals and punish gamblers. Your small account is your training ground to become the kind of operator the market respects. It comes down to 3 imperatives. Protect your capital, grow it steadily, never rush the process. If you can master that with $100, you've built the mental foundation for $1 million. The numbers change. The mindset does not. Patience is more than waiting. It's the ability to wait without destroying yourself in the process. Ruthless patience means you can watch price flirt with your dream entry and still do nothing because the setup isn't there. It means understanding that not trading is also a trade. The market is designed to provoke impatience. Every candle invites action. Every tick whispers now. If you aren't ruthless with patience, the whispers become orders, and you obey them. A trader without patience finds trades everywhere. A trader with ruthless patience finds trades only when the odds heavily favor them. There was a trader who limited himself to 4 trades a month because his system produced only that many high-probability signals. One month he waited 23 days without a single entry. On day 24, the signal appeared. That one trade outperformed what most impatient traders did all month. His line stays with me. If the market will still be here tomorrow, why should I rush today? Patience feels like doing nothing, and that's uncomfortable in a world that confuses activity with productivity. In an office, you type, meet, call. In markets, the most productive act can be staring at the screen and doing nothing. Your hands itch to click. Your mind insists that any action is better than none. And so you chase, you enter early, you self-sabotage. Ruthless patience isn't passive. It's active waiting. It's a deliberate choice to protect your capital until your conditions are met. Some legendary traders made most of their money on a handful of days each year. People assumed they had mystical edges. The real edge was discipline. They knew their setup so precisely that they could be bored for weeks and decisive for minutes. Waiting felt like watching paint dry. Entry felt like stepping in front of a moving train with perfect timing. Redefine winning. Winning is not making money every day. Winning is following your plan every day. If your plan says you only trade when criteria are met, then a day with no trades is a victory. The impatient measure success in dollars. The patient measure success in avoided losses and preserved mental capital. This subtle shift removes the urge to force trades. Impatience inflicts deep psychological damage. Every premature entry that turns into a loss chips away at confidence and pushes you into harder, worse trading just to get back to even. That spiral destroys accounts. Ruthless patience prevents the spiral before it begins. Patience must be trained. It starts with clarity. Without a clear plan, you can't be patient because you don't know what you're waiting for. The mind hates uncertainty. If you can't define a perfect setup, everything looks almost good enough. The clearer your rules, the easier it becomes to sit through the noise. The hardest test of patience is during drawdowns. The temptation to make it back quickly is overwhelming. The impatient double down and chase. The patient accept the drawdown, step back, and wait for the same quality setups that built their equity curve in the first place. It is counterintuitive, and that's why it works. Patience is also the foundation for scaling. Impatience might double a small account quickly and then cut it in half just as fast. Patience might grow at 5% in a month, but that 5% compounds. Small, steady gains build a base that can carry larger positions. Impatience chases explosions. Patience builds empires. You will still make mistakes. You will sometimes take trades you shouldn't, sometimes exit too early. The goal is not perfection. It's to make patience your default state. The more you practice, the more natural it becomes. Fewer trades, higher win quality, lower stress, more freedom. Think of a lion in tall grass. The lion doesn't sprint after every antelope. It waits. It studies. When the perfect target steps into range, it strikes with force and precision. That is how you survive markets, not by reacting to every flicker, but by conserving energy for the moments that matter. The market does not care about your feelings, hopes, or need to be right. It is a mirror reflecting your discipline or lack of it. Most people lose because they tie their identity to each trade. They treat every entry as if it must work. The truth is that no single trade matters. What matters is the collective result of hundreds of trades executed consistently. Revenge trading is what happens when ego meets pain. You see setups that aren't there. You force positions just to erase the sting. The market punishes that every time. Detachment is not optional. It's a survival skill. If your strategy is profitable over time, a single loss, or 10, doesn't matter if you remain disciplined. The danger begins when emotions push you off your edge. Your job is not to predict the market perfectly. Your job is to manage risk and let your edge play out. Define your risk before entry and accept it. If the plan says cut, you cut. If the plan says hold, you hold. No, maybe it turns around. Ego wants to be right. Professionals want to be profitable. Treat each trade like a grain of sand on a beach. One grain does not define the shoreline. Don't celebrate wildly on wins or spiral on losses. Process over outcome. When you stop needing the market to validate you, you make clearer decisions. You stop chasing. You stop hesitating. You start executing with precision. Over time, the math rewards precision. Markets evolve. They punish certainty and reward adaptability. The mental edge that separates survivors from casualties is relentless adaptation. It's not about predicting the future. It's about adjusting when the present changes. The moment you become overconfident in a single method is often the moment the market shifts against it. Comfort is a trap. When the environment changes, adapt quickly. Shorten your horizons, tighten your risk, or sit out until your edge appears again. Treat strategies as tools, not as identity. Consistency means applying sound principles over time, not clinging stubbornly to tactics that no longer work. Make adaptation a habit, not a reaction. Test new timeframes, new risk models, new filters before you need them. Some months you trade more because volatility is your ally. Other months you trade rarely and preserve capital. Adjust without guilt and without fear of missing out. The best traders don't complain about market conditions. They study them, extract lessons, and evolve. Adaptation also includes adapting to yourself. Some days you're sharp, some days you're tired or emotional. Adjust position size, frequency, or abstain entirely. You're adapting not just to the market state, but to your own. Every level of growth demands a different version of you. The beginner mastering risk management, the intermediate mastering emotional control, the advanced reading the market's tone almost instinctively. Reinvent yourself as often as necessary. Now let's make this practical with 3 simple strategies to build ironclad consistency. First, make transparent commitments and start tiny. State exactly what you will do and when, and make it public. Each morning from 7 to 7:10, I will open my charts and record 3 observations. I will not place a trade unless my A setup appears. Share this with a friend or a community. Start with the smallest version of the habit so your mind does not resist. Then report your completion daily. The public commitment leverages your natural need to stay consistent with your declared identity, and the tiny starting step reduces friction so you actually show up. Second, design cues that trigger the right actions. Habits are anchored by cues: a time of day, a sound, a note on your monitor, a checklist on your desk. Link your new behavior to an existing routine. After your first coffee, open your charts. After opening your charts, fill a 1-line journal. After journaling, review your rules. Give yourself a clear start here signal so your brain doesn't negotiate. Third, use micro-rewards and milestones to harness dopamine properly. Dopamine loves frequent, small wins. Instead of letting it drive impulsive trades, attach it to disciplined behavior. 7 straight days of following your rules? Treat yourself to a small reward. 4 weeks of consistency. A slightly larger reward. As progress compounds, so does your sense of identity. I am the kind of person who keeps promises to myself. That identity is the most powerful fuel for long-term consistency. Protect your capital. Grow it steadily. Don't rush the process. Think in decades, not days. Detach from single outcomes, and measure success by your fidelity to the plan. Be ruthlessly patient. Adapt relentlessly. If you can master those behaviors with $100, you've built the mental architecture for $1 million. The numbers will change. The mindset must not. If the market will be here tomorrow, there is no need to rush today. Your job is not to catch every move. It is to take only the moves that fit your edge. The market is a mirror. If you are rigid, it will break you. If you are fluid, it will carry you forward. Be the trader who bends, shifts, and compounds small wins into great ones, quietly, consistently, and with unwavering respect for the process.